Hey everybody, it's Tuesday, November 9th, 2010. Well, it was an old-fashioned reversal Tuesday today across the board. Gold and silver came out very strong, after a string of new highs. I think gold and silver made new highs every day since my last video blog. Gold started out this morning up about $15, closed down 20 bucks. Silver was up $1.50. I think it closed down, it was 70 cents. It was a huge sell-off. Some silver stocks that were up 10% this morning finished close to down 10% by the close. Remember, in bull markets, you do get some violent swings. You shake out the weaker players. I think that's what happened today. What was the catalyst? The CME, Chicago Mercantile Exchange, announced that it was increasing the margin requirements on silver contracts from 5,000 to 6,500. That could have triggered some long liquidation. We had a dollar rally today. The dollar index closed up about 1%. That would have taken the legs out of gold and silver for the day. Oil prices this morning hit a two-year high before closing negative on the day. But some commodities managed to hold their gains. The CRB did hit a new high for the year today. It is making, again, a string of successive new highs. New all-time high for cotton. Sugar hit a contract high. Soybeans were up over 50 cents a bushel, closing at $13.29 a bushel. We actually have beans in the teens. I've never even seen this in my adult life, but I think it was a rallying cry of the 1970s bull market. It's back. And I think today was, again, just a reversal day. Look at the bond market, though. Look at the yield on the 30-year bond rising to 4.25. This is the highest yield on 30-year treasuries in 6 months. And as I've mentioned before, I think the bond market is slowly eroding, certainly at the longer end of the curve. The 10-year was weak today, but I think all our longer-term interest rates are moving up as quantitative easing is already backfiring on the Federal Reserve. It is producing higher, not lower interest rates. Well, before I talk a little bit more about QE2, let me go back to Friday's jobs report because I haven't had a video blog since then. We produced about 150,000 non-farm payroll jobs on Friday, and the market was very enthusiastic because we created twice as many jobs as had been forecast. But I'm still concerned about not only the number of jobs, which, we need to be creating 400,000 or 500,000 jobs a month, but the quality of these jobs. We created more service sector jobs in healthcare and, just retail services. We lost more manufacturing jobs. That shows me the problem is still getting bigger. We need to gain manufacturing jobs. We need more producers, not just more consumers, because the 150,000 people that got jobs, well, they're going to get a check, a payroll check. What are they going to spend it on? Imported goods. So the trade deficit runs up. We undermine our currency even further. We are exacerbating the underlying problems in our economy with these jobs, not curing them. If we had a more free market economy with higher interest rates and smaller government, we would see the restructuring that we need. Now, the world is throwing a lot of criticism on the Fed now for QE2. I think the harshest was coming from Germany. Germany, which understands inflation quite well, called Ben Bernanke clueless. Now, I've used that word before, too, so maybe the Germans are paying attention to some of my, my writings. But the Russian central bank was critical all over. Obama was in India, and I think he's still there. And he made a speech in which he's trying to defend the Fed. And this is really kind of funny because, first of all, he said that he doesn't want to comment on Fed policy because it's not, he doesn't want to compromise the independence of the Fed. Well, there is no independence left to compromise. And the irony of it is, normally it's when the Fed is acting tough. Removing the punch bowl, unpopular, raising interest rates. That's when you don't want to bash your central bank because you don't want to create the impression that the government is putting pressure on the central bank to be too easy, right? Or to be easier, to not be tighter. But when you have people asking Obama to criticize the central bank for being too easy, I mean, that's when he should be criticizing him because the Federal Reserve is acting really in concert with the government to facilitate government debt, to monetize government debt. That's exactly when it should be criticized. I mean, the whole thing is ridiculous. But also, Obama basically said that the Fed has a mandate to grow the economy. Well, Where did he figure that out? I mean, where did he get that mandate? I mean, there's a dual mandate now for price stability and maximizing employment. But where is growing the economy? It's not part of the mandate. And the fact is, the Fed can't grow the economy. You don't grow the economy by printing money. But the fact that Obama, A, thinks the Fed has a mandate to grow the economy, and B, thinks that they can grow the economy, shows how clueless he really is and that the Germans were right. You know, I think the best remarks I saw recently in the Wall Street Journal were from Sarah Palin criticizing the Fed. Really good stuff coming out of Sarah Palin. But, you know, I read this in the Wall Street Journal, and the Wall Street Journal said that this is the harshest critique of the Fed that they have seen from a politician. Well, what's Ron Paul, chopped liver? I mean, Ron Paul's actually in office. And believe me, his criticism of the Fed has been a lot harsher than has Sarah Palin's. No, so is mine. But I mean, I'm not nearly as well known as Ron Paul, and I'm not an elected official, but I did run for the U.S. Senate. And while I ran for the U.S. Senate, I was extremely critical of the Federal Reserve. You know, Ben Bernanke, I think I commented on this before, but in Ben Bernanke's last op-ed piece, where he defended QE2. And I point this out, the irony here, in a new article I have on Europac.net. You should read the commentary called "The Fed Chairman Who Swallowed a Fly." But he wrote a very similar op-ed over a year ago when he was defending QE1 and talking about his exit strategy. And I immediately wrote an article saying that, calling his bluff, saying he was full of it, that he had no exit strategy. And of course, he now proved it. But he wrote another op-ed trying to justify QE2. And if you actually read it, this is what our Fed chairman had the nerve to say. He actually said that the reason he's doing QE2 is because it's going to cause stock prices to go up. And if stock prices go up, well, consumers are going to feel wealthier. And because of the wealth effect, they're going to go out and spend more money because of their rising stock market wealth. And that extra spending is going to cause the economy to grow, incomes to rise, jobs to be created. In other words, Ben Bernanke's brilliant idea to fix the economy, and he thought real hard about this, and he came up with a brilliant idea: inflate a stock market bubble. Let's have some wealth-induced spending. Let's live beyond our means. Let's lever up our assets. Let's spend stock market wealth. I mean, is this serious? How could he say this with a straight face? I mean, didn't we just blow two bubbles, right? According to Ben Bernanke, we now need a new stock market bubble to cure the recession caused by the bursting of the housing bubble, which was created because the Fed tried to cure the bursting of the previous stock market bubble, which the Fed also created. So is this it? Is this all they know? Serial bubble blowing, forever blowing bubbles? That's all they got, right? The Fed knows the Fed can blow two kinds of bubbles: stock and real estate. That's it. I mean, come on. I mean, you know, the definition of insanity, right, is doing the same thing over and over again and expecting a different result. Now, I don't know what's worse: Ben Bernanke, right, for trying to sell us on this concept, or the country for actually buying into it. I mean, where was the criticism in the Wall Street Journal? I mean, haven't they seen this movie before? I mean, how can the cure for the bursting of a bubble be another bubble? And, of course, the irony is it's not going to work. You know, how are stock market prices going to rise? It's commodity prices that are rising. I mean, look at the news we got today from a food company. I forget the name. Kraft Fruit came out on Friday. But even though their revenues are rising, their profits are plunging because their material costs are rising. Companies, the only way stock prices can rise in this environment where there's no inflation is if all the companies eat the higher costs and don't pass them on to the consumers. But if they do that, their earnings are going to take a hit. So how are you going to get a rising stock market with falling earnings? You know, maybe multiples are going to have to go through the roof. But the whole thing is insane. What we need is to reverse course. Right? We need to do the opposite. We can't keep blowing bubbles. We need higher interest rates. We need a real economy. We need productive jobs, not service sector jobs. We have to work our way out of this ditch, not dig it deeper. Anyway, I'm off to London later tonight. I don't know if I'll do any video blogs while I'm there. If I do, great. Mike Tento is going to be subbing for me on my radio show all week at SchiffRadio.com. And I had a great discussion yesterday on deflation. And anyway, If you didn't hear it, tune in on the archives. It's worth listening to. Take care.